U.S. small cap stocks have not been immune to the China trade concerns and other volatilities that have happened in the fourth quarter. We have seen a lot of good assets being priced at a lot more attractive prices now based on the fears that people have about the near term, and because we're long-term investors, we're going to be able to look past that and get attractive assets at good prices. The strategy is overweight financial holdings, and interest rates obviously have a strong bearing on them. We are actually underweight regional banks, and we're going into the quarter. So our lending is more in subprime and direct-to-consumer kind of lending, which has more credit risk than it does interest rate risk. So we think that, one, we're going to do better in the quarter based on the fears that the market now has about interest rates rising. And two, we're going to be able to pick up, again, good assets in regional banks where we've been adding recently on the volatility at much more reasonable prices than they were previously. In the fourth quarter, we saw the best performance out of the most defensive parts of our portfolio. Utilities, REITs, some of our staples did quite well. We also had reasonably good performance in healthcare, where some of the momentum has come out of the biotech sector, and we had some decent performers as well. It's been rough sledding though. Fourth quarter's challenges were mostly in the procyclical areas of the market that had the biggest decline. Info technology, consumer discretionary. We also had a particularly hard sledding in materials, where Venator, which is a supplier of titanium dioxide, has had ongoing problems with one of its mines, and now it's got a demand and price problem associated with it. So it's pulled back sharply. We are continuing to add to it on its decline. We're really finding opportunities across the market, most importantly in the areas that have seen the greatest decline: regional banks, info technology, and consumer discretionary. We've also added to our materials holdings in other places, and we are continuing to look in healthcare for replacements for the things that we've had that have appreciated. We anticipate 2019 will have a lot of the same risk that 2018 did. Policy risk, there will be fears about interest rates and the Fed's moves. We try to look past that. Those are cyclical things that will come and go. We want to look at what this business is going to be capable of doing 10 years from now and think about what will be the long-term risk for them, whether it be the population change or changes in demographics or even climate change. We want to consider the bigger long-term issues rather than the things that are capturing the headlines.